it really isn't worth your while knocking on the door of Scottish Equity Partners or their like. They're going to say no. Much more likely source of funding for emerging companies are so-called business angels. And if you're not familiar with that term, then I suggest think Dragon's Den. Most of you will be familiar with the TV program Dragon's Den. They are, as we'll say later, a bit of a caricature of business angels, but that essentially, the dragons are essentially business angels. There are lots of them around the country. They make small investments, anything from perhaps £10,000 upwards. They're happy and comfortable to invest in early stage investments, even sometimes in startup businesses. They also provide you with more than just money. They are smart investors. They invest plus get involved in their investee businesses, mentoring, providing advice, maybe performing some kind of function in the business. Because they take the view that if they get involved, this will increase the chances that your business will be successful and their investment will be successful. So raising money from a venture capital, from a business angel, means you're getting more than just money. But they're not in the charity business. They are looking to invest in businesses that give a high financial return on their investments. They suffer the same sort of problem as venture capitalists, that only a minority of their investments are going to be successful, so the successful ones have to compensate for the ones that aren't successful. So they too are looking for businesses with high returns, but not necessarily as high returns as the venture capital firm. So here's a definition of business angels, which we could unpack in a minute. But here's the definition. High net worth individuals who invest their own money, along with their time and expertise, directly in unquoted companies in which they have no family connection in the hope of financial gain. So this was a very thoughtfully put together definition. First of all, high net worth. You've got to have a fair amount of wealth to become a business angel, money you could afford to lose. So business angels have to be wealthy. Second point is, they're investing their own money. Remember what I said earlier about venture capital funds? They're professional money managers. They're investing other people's money. And so therefore they have legal obligations of duty of care. Business angels, because they're investing their own money, can afford to be idiosyncratic. They don't have to defend their investment decisions to anyone else, perhaps apart from their partner. So they can be idiosyncratic, they can make quick decisions, and so on. They're investing directly in businesses. They're not investing through an intermediary. There are a variety of schemes out there where private individuals can invest in businesses through intermediaries. But these people aren't, in my book, business angels. Again, as we said earlier, they're investing more than just their money. They're investing their time and their expertise as well. Actually, this is partly why business angels aren't business angels. They enjoy being involved in supporting startup companies. Very often, business angels used to be entrepreneurs themselves. Most business angels became wealthy through their own entrepreneurial activities. And so they get a buzz from starting and growing businesses. And so being a business angel is a way, in a sense, of staying in the game when they perhaps feel they don't want to start yet another business. Somebody once gave me the nice analogy that entrepreneurs are like the parents of a child, business angels are like the grandparents of the child, in the sense that they can still have fun playing with the children, but they know they can pass the children back to the parents at the end of the day and don't have to worry about them at night. So business angels are a bit like that. They don't lie asleep thinking, how am I going to pay the wages next week? That's the entrepreneur's concern. They're investing in unquoted companies, so we're not talking about stock exchange investments. And last of all, again, as we said before, they're investing for financial gain. They're not in this for philanthropy. So, what do business angels look like? Well, typically they are successful, cashed out, disengaged entrepreneurs. They've either sold their business or they put in a professional management and can take a back seat in their business. Again, remember what I said earlier about their ability to add value. Business angels are people who have been there, done that, got the t-shirt. They know the likely mistakes that a young entrepreneur might make and can help them avoid making these mistakes. They're predominantly male, despite the many successful female entrepreneurs we have. 95% of business angels in most studies are male. 45 to 65, again, it kind of takes that long to kind of develop the wealth and grow the businesses to create the wealth to allow you to be a business angel. Having said that, business angels come in all shapes and sizes, so it's dangerous to kind of over-generalize. They've got a variety of different approaches, motivations for being business angels. They're hands-on investors typically, they're active rather than passive angels. We've kind of laboured this point. Many of them invest just on their own or just with one or two other people, but increasingly we're seeing the business angel market organised, with angels grouping together into syndicates or angel groups. We have many of these in Scotland, something like 20 angel groups in Scotland, perhaps one of the best known being Archangels. There's an organisation called Link Scotland that is kind of the trade association for these angel groups. And from the investor's point of view, joining an angel group allows you to get diversity. So if you have £100,000 to invest, rather than making two investments of £50,000, you perhaps can spread that £100,000 across 10 investments, where other members of the angel group will invest as well. You're also benefiting from the expertise of other angel groups too. And it might enable you to see investment opportunities you wouldn't otherwise see for yourself. So from an angel point of view, there's a lot of good reasons for joining a group rather than investing on your own. Crux question then is, okay, how are you going to get a business angel to say, yes, I want to invest in your business? So we need to understand then a little bit about the approach of business angels to evaluating an investment opportunity. What factors do they take into account when looking at an investment opportunity? In fact, again, as an entrepreneur, the odds are against you. Research shows typically angels invest in only 1 or 2% of the opportunities that they actually see that comes across their desk or that they hear about. Moreover, they reject 90% or more of these opportunities just after a fairly cursory screening of the opportunity. They're not even doing in-depth research to reject most of these opportunities. The rest of them either get rejected after detailed investigation or because the angel and the entrepreneur can't agree the terms and conditions and the valuation of the investment. So we need to understand, how can we get the odds in your favour? How can we increase the chances that you will be one of these 1 or 2% of businesses that angels will say yes to? Well, here are some of the main reasons why business angels would say no to an investment opportunity. The first reason is personal. Angels typically have a set of investment criteria, things that they are interested in investing in, things that they're not. It might be industries. They might restrict their investment to industries they know about, perhaps industries they've worked in themselves. They might have a locational criteria. They might only want to invest in businesses within 50 miles of where they live, so they can monitor and get involved with them easily. It might be a funding issue. They might only invest in businesses looking for less than £100,000. Whatever. So it just may be that the angel simply doesn't want to invest in your kind of business. And that's not making any negative judgment about your business. It's simply a bad fit. So that suggests you need to kind of try and get to know the angels before you approach them formally. Try and get a sense of what are they interested in investing in? What have they invested in before? Secondly, the research shows that angels normally don't reject an opportunity because of one reason alone. They have what we've called in the research a 3 strikes and you're out approach. In other words, it's accumulation of concerns or deficiencies that ultimately angels decide, no, this looks a bad deal. So it's not finding one problem, but maybe finding 3 problems. Then they think, this doesn't look a good opportunity. So one of the things is market. Is there a market out there? What's the competition? That would be one thing. So they might reject an opportunity because they think the market is too competitive, or the market's not big enough. Secondly is management capabilities and the personal qualities of the managerial team. Again, remember I said earlier that angels are active investors. They want to get involved with the business. They're looking for entrepreneurs who will listen to advice, who will be coachable. So if they get the sense that the entrepreneur is too arrogant, thinks they knows it all themselves, that they're not willing to take advice, that certainly will be a reason why an angel will walk away. And then thirdly, business issues. particularly USP, unique selling point. What makes it different about this business that will enable it to get the customers? I've heard business angels say, we don't invest in Me Too businesses. So they're looking for businesses where there's something distinctive. And the entrepreneur needs to articulate that distinctiveness in making a pitch to angels. So to throw in a little bit of kind of academic jargon, angels are actually more concerned about agency risk than about market risk. In other words, they're more concerned about the entrepreneur and the management team and their ability to deliver what they promise and their trustworthiness to do what they say they can do, rather than the industry and market conditions. So at the end of the day, angels are making their decisions on the basis of people. And when you think about the newness of businesses, the stage of the business when angels invest, there's actually not very much in terms of the business to go on. So really it's the people largely they have to make the judgment on. When venture capital firms come to invest, they're investing later, so there's more of a substantial business. So venture capitalists are more able to make their investment decision based on both the people and the market business considerations. Presentation actually matters. There's been a couple of studies, one of which is on the slides, which has looked at the effect of a good or a bad presentation on an angel's attitude to the business. So this is kind of getting back to Dragon's Den, because very often what happens is that entrepreneurs looking for money will be invited to make a 10 or 15-minute pitch to an audience of angels. And that's the first and often the only time the angel will have information about that business. And the research shows that the perception of the entrepreneur's presentation by the angels is related to their interest in pursuing the opportunity. In other words, a bad presentation will turn an angel off. In some of my own work, I've had angels say to me after a bad presentation, if this entrepreneur's sales pitch is as bad as his investment pitch, he'll not be able to get any customers at all. So in other words, a poor investment pitch raises doubts in the angel's mind about the person's broader entrepreneurial competencies. So it's critical to work on your pitch. Your pitch matters. What you say and how you say it is just as important as the content. With this background, the next couple of slides are really to get you to think about doing some preparatory work for the group assignment that you'll have subsequently. The first question really is, okay, we've got Dragon's Den on TV. It's in multiple numbers of countries. Hugely popular TV show. How realistic is it? Should entrepreneurs base their approach to business angels on the basis of what they see on the TV show? It claims to reflect angel investing, but the angels I talk to are embarrassed by it. They say it gives angel investing a bad name. Why should this be? Well, read some of the papers on the reading list, perhaps an overview chapter that I've written, perhaps some other things. On the basis of that reading, in what ways is what you see on TV unrealistic of what the research reports about how angels operate? So, just how realistic or unrealistic is Dragon's Den? And the clue is it's neither one nor the other. It's kind of somewhere in the middle. Some aspects are quite realistic, other aspects aren't. So think about that. And the second, and perhaps the more meaty issue or preparation work is to look at a video or CD called You Are the Product. This is something I worked on with colleagues. It's actually a recreation of real business angels discussing an investment proposal for a water rower. And the next slide shows you kind of a picture of this. This is a chap who come up with an idea of an exercise machine, a rowing-based exercise machine that is more realistic of the experience you get actually rowing on water. So the resistance comes from a water tank that you fill. How high you fill the water, how full you fill the water tank affects how easy or difficult a row it is. And so this business, real business, was looking for money to grow the business. They got a small number of products already made, got some sales. It wanted to expand, and it approached various business angels. And I used their documentation to ask various business angels what they thought of the proposal. And that information was used to create the scene that you'll be looking at. Number of questions to think about. You quickly realise watching the video that the angels were not very interested, or were rather critical of the proposal, and ultimately decided that they didn't want to pursue it further. So why did the angels reject this investment opportunity? Secondly, what were the main deal killers? What were the kind of three strikes issues that agitated the angels? What aspects were less important? Angels made a lot of other criticisms, but only some of them they actually carried weight with them. So what were the points that carried the most weight? What was the attitude of the business angels as they interrogated the business plan? How would you maybe describe that? And then finally, let's suppose that you're now a business consultant, and this poor entrepreneur, having been rejected by the business angels, comes to you and says, I still need money, I screwed it up with these guys, advise me how I should make a better presentation to another group of angels. How would you advise this entrepreneur to rewrite his business plan and his pitch before he met another group of business angels? And if you're kind of really keen, here's a supplemental thing to perhaps think about. A paper I wrote with a former student of mine who now is in a senior position in the accountancy firm Tenon. I was just hearing the other day, only 10 years out of graduating. This paper was actually written on the basis of his undergraduate dissertation. And actually, it's one of the most cited and downloaded papers of mine that I've ever written. So it just shows you a good undergraduate dissertation can actually make it into the academic literature. And this paper was comparing how bankers, venture capitalists, and business angels all reacted to the same investment proposal. And what we found was that these three groups focused on very different kinds of information. They interrogated the business plan differently. Which suggests, of course, that you should have a different business plan for these different types of investors. But the question really to think about after reading the paper is, what kinds of information do bankers focus on? What kinds of information do business angels focus on? And why should they focus on different kinds of information? Here's some reading, and best of luck in the assignment. Thank you.